Good morning. Welcome to America First Wealth Management Investment Outlook for Monday, September 22nd. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. Joining me today is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Let me just start my slides here. Okay. So this is just our standard disclaimer here. This presentation is just for informational purposes only. We're not offering any investment advice, recommendation to purchase or sell any securities, and this is our opinions as of data as of September 22nd, and our opinions are subject to change. So what we like to do in our investment outlooks every week is start off with our conclusions first, and then more detail later, so viewers can get to the point right away, and a lot more data follows for those who are interested in listening. So my market outlook for this week is that, for one, the trend is our friend until it ends. And since I've been calling since the beginning of the month that I felt that September will be a positive month, I still believe so, even though history says most Septembers are the worst month of the year for stocks, with the exception being an election year, which this is, where 62.5% of the time, September has yielded positive results. And that's certainly the case because now September month to date is positive for the S&P 500. The recent pullback we saw at the beginning of the month, I'm just repeating what we've said for the last 2 weeks, that the pullback was a correction in the broader upward move, and it's a buying opportunity. And we continue to see broadening of equity performance, particularly in small caps and also in value stocks. The Fed rate cut last week obviously is leading to a weaker dollar, which I know Michael's going to talk about later on. And it tends to favor commodities, namely energy, industrial, and precious metals. Also favors stocks that benefit from stronger foreign earnings, and that's namely emerging markets and international stocks. The key macro data points this week will occur on Thursday and Friday. Thursday, 8:30 a.m. will be durable goods orders and GDP growth rate. Also, 9:20 a.m. on Thursday, Jerome Powell will have a speech, so that will be something important to tune into. And on Friday, 8:30 a.m., the core PCE price index, personal income, and personal spending. Those will be the key macro data points for the week. The weekly market stats. It was a positive week in the green for all equity stocks, all equity indices, namely led by NASDAQ Composite and NASDAQ 100. Small caps, as I mentioned, continue to show good performance, up over 2% for the week. And we're seeing pretty much across the board other equity indices up. Bonds gave back a little as the 10-year bond yield rose after the Fed rate cut at the short end of the curve. For the month to date, everything is in the green except for international stocks. But if we're right in the call that as the dollar weakens, international stocks should perform well, we should expect that to change as well. The S&P 500 index, the trend continues to be our friend. As we see, it's now up on the month and continuing to rise on the year. We're above the 10-day moving average, which I've noted has been a pretty good barometer for direction of stocks and also highlighting any changes in trend. The RSI, Relative Strength Index on the bottom, is getting a little to the overbought area, but still has room for advancement before there's a bit of a pullback. So I think we're still poised for a continued rally through the end of the month. The 10-year Treasury yield, as I mentioned, popped a little bit. We're up. Actually, yields. I am sorry. The yields actually rose 6 basis points on the week, not down 6 basis points. So that is incorrect calculation. So we went from 3.66% to 3.73. That's up 7 basis points, I believe. So the math is wrong on that. We'll have to correct that. Our apologies, but You can clearly see the little rise in the interest rates on the week. And we also cross the 10-day moving average, which tends to be a bearish signal for bonds as the Treasury yields rose. The yield curve, as you can see, the blue one on the 20th, we see a slight pickup at the longer ends. However, we see at the shorter ends, with the Fed drop in rates, the short end of the yield curve dropped on a week-to-week basis, but on a longer end, you can see that little inversion there. But we're still showing overall decrease in the yield curve from the beginning of the year till present. We still have an inverted yield curve from the short end to the longer end, but we have a normal shape if you go from the 3-year to the 30-year with rising rates there. So it probably suggests there's more room to go in terms of short rates dropping and longer rates rising, but Michael will be the expert on that. I'm sure he'll comment on that. The 10-2-year Treasury spread still shows steepening, which I'm sure Michael will talk about that, but steepening usually suggests that there's going to be some certainly changes in both sector leadership and certainly implications for financial stocks, because as the yield curve, the spread widens, there's opportunity for financial stocks to benefit from that. They typically borrow at the short end and lend at the longer end. So as this spread rises, usually bodes well for financial stocks. So we're keeping an eye on financial stock performance because of this. And with that, I'm going to turn it over to Mike. I'm going to stop my share, and Mike, you can share your screen.
Okay, thanks, Dan. Let me turn into a slideshow from beginning.
No, current slide.
All right. Well, the good news is that the Fed is working very hard to prevent a recession. The bad news is as the current growth rate is already very strong, with this Fed cut and signal of more cut coming, it's going to be the growth rate is going to be even stronger. So the question then is, how soon will inflation reaccelerate? An important question to think about is, why did the Fed start this rate cut cycle so early in this business cycle? And as I mentioned, I'm looking at how soon will inflation reaccelerate and become a problem. So we will be watching the long bond yield and other indicators that may signal that the Fed could have been a little bit too early. Well, look at the Fed model, right? Just when they started to cut rates, GDP, according to the Atlanta Fed model, is running at 3%, right? Way above the blue chip consensus. And a surprise to everybody is that US jobless claim falls to the lowest level since May in a solid labor market. Application for benefit dropped to 219,000. And for reference, over the last many decades, the recession get into trouble when the claims number get above 350,000. 350,000 compared to where we are to 19,000. And perhaps they are looking at this part of the economy where the yield curve, the 10 to 2, has started to steepen. And previously, when we steepen, that's where we get into a recession, right? And just so that we are clear, an inverted yield curve predicts a recession. But the recession starts when the yield curve steepens again, right? And just for reference, the yield curve is steepening, but it is nowhere near where we were cycle, where the steepening was a lot more when the Fed cut rate. And inflation, again, in the same week when the Fed started to cut rate, we are really seeing indication that whatever improvement we have seen in wage inflation have stabilized and starting to turn up, right? And the Philly Fed manufacturing price paid has also spiked up here. So given the signs that we are seeing, the Fed started to cut rate when the economy is still extremely strong. In terms of monetary policy, the median of the dot plot is this light blue line here, and the Fed funds market has priced in a more aggressive rate cut, with the market expecting the Fed would increase rate in the 2006 and 2007. Well, the Fed projection is interesting. They have revised their unemployment expectation to a slight increase and a slight drop in PC inflation and a slight drop in core PC inflation. The thing that surprised me also is that in their official statement that they released, they talk about how inflation, right, has made further progress to the committee's 2% objective, but remain somewhat elevated. So if it remain elevated, why cut rate so soon? Okay. And here's a chart to show that unemployment rate is on the low side for the Fed to cut. Like previously, the Fed would cut rate when the employment rate is about 5%, but now they are cutting rate when the unemployment rate is extremely tight, very strong economy. And this also rarely happens. The Fed cut into an earning per share recovery. Like previously, when the Fed cut rate, earning per share come down, the cut rate, right? And the cut rate, when it's still very strong, right? No doubt, Bank of America is forecasting this to be down, but we are not there at all. Well, why is this important to someone like me who watches the economy and the bond market? The reason is we will not get a recession unless companies fire workers, because consumption is 70% of GDP. Companies will not fire workers until they see the earning per share come down, until they see profit margin get squeezed, right? So we are nowhere near there at all, and yet the Fed went ahead to cut rate. And because they have cut rate, chances is that companies are less likely to fire workers, and therefore the Fed has successfully avoided a recession, or they've lowered the chance of a recession happening. And this is also very surprising. The Fed is cutting when the overall financial condition is still easy. Look at the time when we had a recession during COVID, right? Where positive means the Chicago Fed National Financial Condition Index is very tight. Here is very tight, and here, and here, and here. But this means that the financial condition is very easy. Banks are lending money, and there's a lot of leverage in the system, and the consumers can get credit to spend. So it's very strange. It's very strange that we talk about how in the past the Fed would take away the punch bowl when the economy is getting doing well, but here they are like adding more fuel to this economy that's booming, and this leads to the bond market. And here, this chart shows that the U.S. economy now relies entirely on foreign net savings. Why do I care about this? Well, that means that we continue to need foreign investors coming in to buy the bond market here. If they don't, then interest rate is going to go up here. At what point would foreign investors stop buying the US bond market? Perhaps when they see that the Fed is less concerned about inflation. And that could lead to the weaker dollar and fit into a negative cycle. A weaker dollar means less foreign investment coming in, lead to high interest rate and inflation fear that again leads to lower dollar. And here, 10-year yield have slowly risen on average when the economy avoided a recession, right? So if you look at the average without recession, this is where I think we are in, because I think the Fed has done a lot to prevent a recession. And we are going to see the 10-year yield, right, based on historic experience, to rise over the next 3 months. And so I'm looking at the possible canaries in the coal mine. And guess what? Well, this is TLT, right? The Fed cut rate and TLT dropped sharply. Interest rate in the long end, as Dad has mentioned, went up the week the Fed cut rate. And second canary is the dollar. Initially, when the Fed announced the decision, dollar dropped, and now on a week-to-week basis is about unchanged. But I'm going to follow this very closely in case the dollar starts to decline from here. And this chart tells us that we are now at the major chart point, right? Trading close to the previous high. So let's see if this is going to break. If so, it may get down to the next support level. Gold is the other canary that we're looking at, and gold did very well after the Fed announcement and closed the week high, closed the week at another new high. Well, then I'll stop share and back to you. Then you're muted. Then you're muted.
Got it.
Okay.
Okay.
Good. Yeah.
Yeah, I wouldn't call gold a canary. Usually a canary drops dead in a coal mine, but gold is rising like a phoenix here. So
well, a higher gold price will may signal fear of inflation, right?
Yes, yes.
Yeah.
Fear of inflation, and as you've noted, it could be loss of appetite for U.S. bonds and shifting by central banks in terms of continuing to add to gold. So we've been watching that closely, and certainly our portfolios have benefited because we have been participating in gold equity mining stocks for some time now, and all of these names are outperforming the S&P 500 here to date. Anyway, shifting over to the Magnificent Seven, all of the Magnificent Seven names, with the exception of NVIDIA, were up for the week, led by Meta, up 7.1% on the week. And NVIDIA had a strong week in the prior week, but gave back pretty much those gains this week. NVIDIA is now down month to date. The leader for the month, surprisingly, is Tesla, up 11.3% for the month, but still down year to date. So a lot of room to play catch up there. The leader for the year to date continues to be NVIDIA, and followed by Meta on the year to date. Sector performance. Energy, not surprisingly, was the leader for the week. Energy had been a laggard, as you can see, for the quarter, down 2.6%. Energy sector is the lowest performing sector year to date, only up 7.6%, where all the other sectors are up double digits year to date. Real estate was the largest underperformer for the week, as the longer end of the yield curve did rise a bit after the Fed rate cut. Defensive stocks also largely fell during the week. Consumer staples and healthcare were down. And that's pretty much it for the week. A lot of action, a lot of reversals. Certainly on Fed Day during the week, there's just a lot of moving pieces in terms of sector performance during the week. I'm throwing in this chart. This is Michael has shown this chart before. This is the Strategic Petroleum Reserve. As he had noted before, we're at a pretty low level with the low oil prices. Probably represents a good opportunity for the government to refill the reserves. And this is West Texas crude. You can see the little spike in oil for the week after being largely down for most of the year. We think this probably represents, I think, a good opportunity for energy prices, energy stocks to do well here, probably through year end. We're correct that the government takes the opportunity to refill the SPR, and the dollar continues to decline. Energy prices should continue to see a rally here. Qualitative and style factors, pretty much everything was up for the week. You can see pretty much everything's been very strong. Mainly, it's been the momentum and growth factors that have been the strongest on a year-to-date basis. You see momentum up 28.7, growth up 23.35. Spin-offs have also done very well on a year-to-date basis. But pretty much everything has been working. It's been all about how much risk do you want to take in this environment, as it has been a pretty bullish year for stocks. Turning over to commodities, we see a rally in the energy commodities during the week, led by natural gas. Gasoline, Brent, heating oil, crude were all up. The only laggard was ethanol for the week, but pretty good turnout for energy. Industrial and precious metals were all up on the week, as expected, as I mentioned, with a weakening dollar. These will tend to be good opportunities. Turning over to agricultural commodities, had a huge bounce in sugar, which unfortunately we're not aware of any equity plays in sugar. But anyway, it's something worth watching. It obviously has an impact on confectionery prices and some of the consumer staples companies, but that tends to be on the negative side. Other than that, nothing really interesting to note. Cocoa, again, being the strongest commodity performing year to date, up 83%. It's going to be a tough Halloween as parents get sticker price shock when they buy candy for Halloween. Turning to the economic calendar, there's a lot of data points, but I'm not going to go through all these, but as I mentioned, the key data points will be on Thursday and Friday. Turning to S&P 500 company earnings, just a handful of companies reporting on the week. I would say that the important names to highlight will be Micron and Costco. Micron, obviously an important semiconductor name. We're looking for earnings of 111 for Micron, up 218 versus a year ago. So that's a big move. I had negative earnings a year ago. Micron is a key bellwether for memory semiconductors. So we're looking at that carefully. Costco is a key bellwether in the defensive consumer staples space, but also it's a key bellwether, I think, for middle class and their discretionary spending dollars. So looking at 508 earnings for Costco, up 22 cents year over year. And that's kind of it for the key data points and earnings for the week. Mike, if you have any closing comments, if not, I'm going to say, please contact Cleveland Ashley. His information is noted here for anyone who wants any more information on our products or services, or to schedule a one-on-one call with us. We're here to help and happy to talk to any of our investors or prospective investors. So with that, we'll be signing off for this week. And Mike, anything you want to add?
Now, we are here to help. Just let us know how we can help.
Okay, great. All right, take care, everyone. Have a great week.